Hello there, welcome to this edition of Global Business Africa. New start to the week, new set of stories coming your way from Cairo, Johannesburg, Lagos and Nairobi. We've got plenty of ground to cover, let's get to it. Here's what's coming up. The East African community teams in a last-ditch effort to save exports from taxation in Europe. A Kenyan dry cell manufacturer changes tack to compete with imported goods, and we'll be looking at the business of making profits from this very rare delicacy. Let's start in East Africa's biggest economy, where the Supreme Court in Kenya has set aside a ruling by the Appeal Court on digital migration, and it's essentially sent back the Communications Authority of Kenya to the drawing board. It has been ordered to reopen licensing of broadcast signal distribution for 90 days. The Supreme Court has also ordered the regulator and 3 local media houses to agree on a new timeline on the migration from analog to digital broadcast systems. Now, in October last year, the Nation Media Group, Royal Media Services and Standard Media all filed a petition at the High Court against the proposed switch to digital television broadcasting. The media firms opposed a decision by CAK denying them, they said, digital broadcasting licenses. Now, the regulator had awarded the licenses to StarTimes and GoTV. The Supreme Court has also recommended that CAK ensures that the sale of set-top boxes was required by viewers in order to watch programs transmitted on a digital format to be open to competition. Let's talk about an electronics maker now. Electrostar was established in the early 80s with a license from Zanetti, essentially to make refrigerators. Right now, though, it's got 7 factories churning out its own brand of electrical appliances, from ovens to TVs to freezers and fridges. It's also working under license from several international brands and employs over 2,000 workers. Yasser Kim spoke with the founder of the group about the investment environment in Egypt and much more.
Electrostar is a leading manufacturer of home electric appliances. Since it's been established in 1980, the group witnessed a high boom in the market and business until 2011.
President Sisi has made a lot of improvement, but really, after 2011, there were demonstrations, violence and strikes, which led to a drop in production by 50%. Even more with sales. We nearly closed down 5 of our factories. Since the president took over, things improved dramatically. Suddenly, people are buying and the market is moving fast. I'm surprised, honestly, how our sales suddenly shot up. We are now expanding even. We are studying new markets in Arab and the European countries.
Electrostar exports 40% of its products to the Middle East and North Africa, but it also exports to Kenya, Angola, Zambia and Senegal, amongst other countries in Africa. Mohammed El-Manoufi complains, however, that investment environment in Egypt is not so encouraging.
We have problems to acquire land. It's very expensive, which hinders our expansion. Licenses take too long and complicated procedures. Bureaucracy is our biggest problem, and it's one that all governments so far have failed to address.
Speaking about China, Manoufi says it's the next economic superpower.
China has become an integral part of our life. We cannot do without Chinese products. They are everywhere, good quality and affordable. I visited China several times and I import components from my industry from there, such as Respectable Hair Group. I just signed a partnership deal with a Chinese company to import and produce high-end solar-powered electrical appliances.
Yasser Hakim, CCTV, Cairo.
Let's take it to Ethiopia now, where 2 multi-million-dollar railway projects are currently under construction. The first is a light rail line in Addis Ababa. The second, a long-distance rail line that links a port in Djibouti to the Ethiopian capital. Girom Chal has been following developments in both projects. He filed this report.
34 kilometers of modern light rail line has been constructed here in Addis Ababa, aiming at solving the tormenting transport problems experienced by the city's residents each day. It is now close to 80% complete.
Addis Ababa is going to be the first, city to have such a transport system. It is going to change the transport problems that will occur within the next few months, we believe, along the corridor.
It is a happy moment for Ethiopian public transport users. The first 3 rail cars are now in town. They are a face of the latest state-of-the-art technology in the industry.
Oh, this train is, as you see now, the state-of-the-art train, and with all the safety equipment and gadgets in it. And it is one of the best now manufactured in recent times, and also in terms of speed, in terms of comfortability, in terms of whatever you say, it's air conditioned.
I should be one of the few Ethiopians who have got the chance to board this much anticipated train, and it feels so good. It's hoped that this train will carry 15,000 passengers in one direction, and in all 4 directions it will be around 16,000 in 1 hour. That simply means problem of transportation solved. The government plans to scale up this whole practice across the nation.
The success of the first phase of the light rail, the 34 kilometers of the light rail, will produce more light rail demands. So the city will have more, light rail extensions. We have 2 lines now. We could extend them to a number of lines.
Ethiopia is also building a 760 kilometers cross-country heavy railway. When finished, it will connect central Ethiopia to the port of Djibouti.
Addis Ababa Djibouti is our priority. It's advanced more than 50% at the moment. It will continue to advance in the next year, and probably before the end of 2015, we should, start, operating the Addis Ababa Djibouti, project. We believe.
The significance of all of these infrastructure developments in this nation, observers say, will open more windows of opportunity for this ambitious nation to climb the ladders of success in all sectors in a short time. Grumtala, CCTV, Addis Ababa, Ethiopia.
Let's move on to trade row right now. The EAC trade bloc is making last-ditch efforts to prevent exporters based in the 5 countries that make it up from incurring losses of over $140 million a year, following their failure to broker a trade deal that would have allowed continued duty-free, quota-free access to the EU. An East African team of negotiators is expected in Brussels this week to discuss the EAC's new proposals. Right at the top of their agenda are plans to convince the EU to prepare a legal instrument that will enable a smooth transition of exports from the duty-free regime of the market access regulation to the generalized system of preferences regime. Products under the EU GSP tariff are subjected to lower taxation than those under the normal EU tariff. Fresh roses and cut flowers, for instance, would attract import duty between 8.5% and 12% under the normal EU tariff, and between 5% and 8.5% under the EU GSP. Now then, let's get more details here from Jack Barton. He's live in Brussels right now with more details on what you should expect in those talks between the 2 parties. Jack, according to the 2007 interim EPA deal, these 2 parties signed. A comprehensive agreement should have been signed by 2009. From the EU's perspective, what has stopped both sides from signing a deal 5 years on?
Well, there's no such thing, of course, as a fast free trade agreement of any description, perhaps with the deal between the EU and the Caribbean being one of the rare exceptions. So just simply the negotiating stumbling blocks have been one of the biggest obstacles, but there are many other factors at play here. One of them is back in 2007, when an interim deal was supposed to be in place. Of course, the East African community broke away as a bloc from a larger bloc that incorporated some southern countries as well. So just at that point where there should have been an initial signing, it created a whole new bloc. And so when right back to the beginning of the negotiating process. So that was a big setback. Another reason, though, is because the community, compared to other groups like SADC and ECOWAS, who really have the European Union as by far their biggest trading partner, this is not the case with the East African community. For most of the 5 countries there, it is, well, actually for the bloc as a whole, it is really India has double the trade, almost double the trade volumes of the EU. China almost double the trade volumes of the EU. It's really in a third place back there, and in a quite a far back in third place. So it doesn't really have that importance that it does to the other blocs, but it does to Kenya, because the EU for Kenya, which is the most advanced economy in that bloc, of course, is very important, and that's why it has been Kenya that's really been the country pushing forward here to try and get this agreement signed.
Indeed. Let's look at the hard numbers here. What imports from the region will be hardest hit by the higher tariffs that kick in on the 1st of October?
Well, across the bloc, it's really the export of raw produce, and this is why it's been one of the big sticking points, because what the EU wants is the tariffs or the export taxes scrapped on the exports of raw products, and all 5 countries in that bloc are saying that is going to lead to an enormous loss of revenues. But for Kenya in particular, there is a lot that they will lose by losing the current agreement. So if we look at just the exports to the EU of cut flowers and of vegetables, 2 of the biggest exports, that's about $840 million worth of exports a year. So, you know, there's been reports in the press of new tariffs, of tariffs going back to 30%. I've spoken to officials today that say it's not going to be that high. But of course, any increase on a sum like that means a big loss. And if it's not being felt by the private sector, that will be because of compensation from the government. So it's going to be felt in the public sector. So any way you look at this, there is going to be disruption. And of course, even if Kenya signs in the 24 hours before the deadline elapses, there's still going to be disruption. It'll be a couple of months of the old tariffs coming back into play merely because of the time it takes to sign off on the new deal.
Indeed. Finally, Jack, do EU officials have any ballpark figure when they expect a comprehensive EPA deal to be signed between the EU and the East African community?
Well, if the agreement that's currently on the table, and from what we've heard, the East Africa community has, as of Friday, finally agreed on their negotiating point, their negotiating position. If that can be initialed tomorrow, or even if it could be ratified tomorrow, there's still going to be a couple of months of disruption, because after that there's a process where it has to go through the European Council. The leaders there will have a look at it, sign off on it, or raise their disagreements, and it has to go through finally through the European Parliament. That will take at least a couple of months. During that period, countries are going to go back to some of the old systems. It's not going to be very disruptive for 4 of the countries that are categorized as least developed nations, so they'll go back to a deal called Everything But Arms. But for Kenya is the odd country out there because of its developed level. It's going to go back to another agreement, and it'll be the only country in all of these blocks that are negotiating at the moment that will be hit with these larger tariffs. And it's unavoidable at this point. It's going to happen at least for a couple of months. But the hope is it'll either be signed tomorrow, if not next week, and then the EU will try and fast track through this process. So the hope is that it will be 2 months at the longest, perhaps 3, but perhaps they can fast track it through to 6 weeks and get everything back on track if it can be initialed and ratified.
Indeed. Jack Barton there from Brussels with the details on the sledgehammer that is the EU generalised system of preferences, which will take effect and hit Kenyan exports fairly hard. Quick run through the equity markets here for you just before we run into a break. South Africa, interesting developments over there. Amplat shares down 2.5 percentage points after its finance director left, heading over to Sasol, we understand. Over in East Africa, the Kenyan 20-share index up by about 0.7 of a percentage point there. Centum, the top gainer on the day, up 9.2 or so percentage points. The correction that we saw towards the end of last week with some investors has, in their opinion, given them another entry point into the market. South Africa is launching a campaign to revive its tourism fortunes. We'll have the details. And a Kenyan dry cell manufacturer is changing tact to compete with imported products. All that and more is coming up in the next 15 minutes. Africa is on the move. It's home to 7 of the world's 10 fastest growing economies. we help you make sense of the fast-changing African business landscape. We take you where the business is happening. Welcome back. 15 minutes into the hour, you're still watching Global Business Africa. Now, the hotel industry in South Africa is starting to gain a bit of momentum after a slump following the financial crisis in 2008. Room occupancy rates had fallen all the way to 50% with cutbacks of business and leisure travel. But the sector is now poised for a return. Here's Sumitra Naidu with the details.
Tsogosan has been around since 1969 and has become the largest hotel group in South Africa. It owns and manages a wide range of hotels across the country and the continent, employing around 18,000 people.
We have just over 90 hotels with about 14,500 rooms. We cover all market segments, from budget right through to deluxe, principally in South Africa. 85% of our hotel business is based in South Africa, but then we are present in 7 other African countries.
The group's occupancy rate has averaged at around 68% over the last 20 years. Most of its revenue is generated from local business travel.
Where we make our money is large city hotels, as opposed to resorts and that sort of thing. Probably about 90% of the business that we do is business-based. So we say colloquially that our average customer brings a briefcase and not a bucket and spade.
But with the global economy still trying to shake off the pain of the financial crisis, business travel has been scaled down. South Africa too is struggling with a weak economy and high levels of unemployment.
Supply in the country is absolutely stable, and there's not a lot of demand for building new hotels because we're still below optimal occupancy. And you've had a recovery in demand from the corporates, but nowhere near to what the levels it was prior to the slump.
While the industry is doing better, it will take some time before it can reach levels seen prior to the financial crisis.
At the moment, the economy is not doing well. It's sitting at about 1% growth, when it should be at 4 or 5% growth. But the minute that GDP picks up, all levels of activity kick in, and then your corporates start travelling, your government travels more, and that's where you get the strong uptick in demand.
Tsogosan is well placed to expand its presence in Africa, but it's taking a cautious approach.
Where we're going to be focusing in Africa, it'll be individual projects that we identify, as opposed to saying we're going to roll out 50 hotels in 5 years, because the markets just aren't there for that type of expansion.
South Africa is still a popular tourist destination. Last year, close to 10 million foreigners visited the country, almost double the world average of international tourists. The industry currently contributes around $100 million to the country's GDP. Government has now made tourism a key sector and has set a target for the industry to contribute up to $500 million to the economy by 2020. Sumitra Naidu, CCTV, Johannesburg.
Let's talk about manufacturing in Kenya. Everready East Africa will be closing its manufacturing plant in Nakuru, Kenya, citing competition from imports, which have essentially made its locally manufactured products non-competitive from a price standpoint. Its managing director, Jackson Mutua, says the company plans to import batteries for Kenya and the East African market from Egypt in the future. Now, the plant does produce dry cell batteries. Those constituted roughly 60% of the company's turnover, and it has been running at about 25% capacity. The closure will see about 99 employees laid off at a cost of over $1 million. Once the shutdown and the layoffs are complete, the company will be using the 18.5 acres of land for real estate. To that end, it has set up a subsidiary, Flamingo Properties, to operate in that field. The company also plans to launch new products right across the personal care, energy and household categories as well. Jackson Mutua, as I mentioned earlier, is a managing director of Everready East Africa. He's with me in studio right now. Thank you for your time.
Thank you.
It's been a long day for you, hasn't it?
Yes, it's been. We've been discussing our new business direction with Kenyans and trying to explain where we want to go as a business. And we feel that we are now better positioned to be able to position the business on a path to growth and profitability. All right,
let's start with a broad overview of your business, because most people think of Everready and we think of batteries, but there's a lot more to what you do than just selling AAAs and AA batteries and D-size batteries. What are your main business lines?
Agreed. Actually, our business is categorized into two broad categories. we have what we call the household products, which is mainly the batteries, flashlights, and lanterns. Within the battery category, we've got about 3 technologies. One is carbon zinc, alkaline, and lithium. And within Kenya, we only manufacture one line of carbon zinc, which is what traditionally is called the D battery size. The rest of the product lines, across the household, are imported from various affiliate companies across the world.
So if you were to put it in terms of turnover, how
Yes.
much of your turnover is directly linked to your manufacturing plant in Nakuru?
It's about 60% currently, yes.
All right. Looking forward, all factors being constant, assuming, say, for example, counterfeits are not a big problem.
Yes.
What's the cost advantage of importing those D-size batteries from Egypt instead of manufacturing them here?
There are actually 4 main reasons why this is one of the best decisions for the business. One, of course, is you remember when we manufacturing this battery, much of the raw materials that we import, that we use to manufacture the battery is imported. A battery is about 80% cost in terms of raw material. And 70% of those raw materials are imported from mainly Asia. And therefore, by moving from manufacturing to importing these batteries ready-made, then we are cutting down the cash conversion cycle by almost 80%. Instead of importing raw materials and then taking 6 months from importation to manufacture to sales and collection, we'll be importing a ready-made cell, and we will be getting open credit from our partners, and therefore we'll be significantly reducing our cost of financing of the operation.
Under what circumstances, if any,
yes,
would the Nakuru plant be financially viable? Running at 25% capacity surely can't be making any money.
If we were operating on a normal environment where all players are playing by the same rules, we're not having any illicit products in the market, where some of the product and some of the players, are not paying taxes, are not meeting standards, and therefore they're only competing with us on account of price to the consumer. If I ask you today who our competitors are in the battery size category, chances are that you can't mention one. Why? Because they do not exist in the conventional outlets.
They don't run around and do adverts and do
Agreed.
in-store promotions and that sort of thing.
Exactly. So the only push is targeting the consumer because of disposable incomes and looking for that cheap pricing level where they can be able to compete against us. But if we had a level playing field, we would be controlling about 78% of this market.
Looking at your conversion from being a manufacturer onto being a distribution firm,
Yes.
more or less, how does that affect your foreign currency exposure? Does it reduce it significantly, or does it essentially remain at the same level?
It actually makes it much better because, as I said, we only manufacture one line of our products, and that's the D-size battery. The rest of the products are all imported. More so, the battery that we are importing, we are manufacturing, is manufactured using 80% imported raw materials. And therefore, in terms of exposure, there's no change in as far as foreign currency exposure is concerned. The thing that we're benefiting from is cutting down the cash conversion cycle from importing raw materials and converting them into a battery, but now importing the battery and ensuring that we can be able to turn around our cash faster than when we're importing the raw materials.
All right, we'll have to leave it there. Thank you for your time this evening.
Thank you so much.
That's been Jackson Oto. He's the Managing Director of Everready East Africa, and we've been talking about the conversion of the company from being a manufacturing firm to mostly being a distribution company. Moving forward, let's make a quick run through commodity prices here for you. Not much of a change from the broad trends that we've been observing over the last couple of months. Everything on your board tonight, however, firmly in the green. Cocoa, coffee, gold, crude, you name it, it's heading up. "20 minutes in, we'll be looking at the business of ostrich farming. Can you make any money from these enormous birds? The answer is yes. We'll tell you how next. Welcome back. Ostrich farming, by its very name, by its very nature, it's a niche business in Kenya and East Africa, mostly due to restrictions on what you can farm commercially, especially when it comes to wild animals. Those limits notwithstanding, it is profitable for those who can meet the stringent requirements in place. On Grassroots tonight, you take a look at the Maasai ostrich farm. It's the only one of its kind in Kenya.
A farm worker attends to ostriches at the Maasai Ostrich Farm, about 40 kilometers south of Nairobi's central business district. It's a rare vocation in eastern Central Africa, so rare that there is only one private farm in the region that specifically caters for this largest but flightless bird. The idea was inspired by a trip to South Africa, where the trade is a lot more developed.
The South Africans weren't doing anything that wasn't available in Kenya. Yes, they might have had the expertise with handling the birds, but beyond that, environment is similar. The staff and the level of staff you'd need is available in Kenya.
That was back in 1989 when Senior Kulei converted his upcountry house to an open getaway specifically serving the rare delicacy. Having grown up in the farm, the son was charged with turning a profit out of what started out as a hobby.
The business itself, the ostrich business and the meat itself is very lucrative. The demand for ostrich meat within Kenya is very high. We as a farm only supply within Kenya at the moment, and we can't meet the demand. We're trying to grow our herd, try to grow our breeders. If we have a good laying season, for example, we may get close to 2,500 eggs. Which would hopefully mean we'll get enough to supply Kenya.
People are becoming aware of the ostrich meat and the quality and the value of the ostrich meat. It is low in cholesterol, it is red meat, and it is healthy. So a lot of people are now moving away from the normal red meat, cow, beef, to ostrich.
And it is in that the business thrives. A kilo of ostrich meat costs anything upwards of $35, while an egg could attract anything from $40 each. Ostrich skin and feathers attract revenue too, as these are rare and serve decorative purposes. While the farm currently enjoys a monopoly, farm managers are reluctant to take pride in that and say that they are continuously seeking innovative ideas to stay profitable and remain ahead of competition.
We have decided to refocus on domestic tourism. We are now quite big on team building, weddings. We have beautiful grounds which we use for weddings and team building. So we've diversified a little bit in our marketing strategies.
And it has not been a walk in the park.
We get a license from the Kenya Wildlife Service every so often to go out and collect wild eggs, but this is rarely done because we have to avoid people poaching, for example. So generally, most of our ostriches are actually grown ourselves.
An ostrich hen lays an average of 60 eggs a year, and while demand is high, it is also imperative that the farm works extra hard to increase its flock to meet demand. Years of practice, they say, has made the farm better, and every season turns out better than the previous.
We're now in the breeding season. The breeding season begins in June and it goes all the way to March, April, and we are anticipating to get at least 1,000 chicks within this time.
What we're hoping to do is in maybe late 2015 is start exporting to the general market, maybe to the Far East, to the Middle East. There's a good demand in the Middle East, and Europe as well. Germany is one of the biggest markets outside Africa for ostrich meat, and it's a very good target. It's a viable target for our business.
The farm currently employs just under 70 staff and has incorporated ostrich rides at the price of about $3 as part of the package. The farm has also put up cottages to make a weekend getaway complete. It hopes to increase its flock from the current 250 birds to 3,000 in the next 18 months.
You need to give people what they want. You need to understand your product and what the market wants. And once you understand what the market wants and give them what it is that they want, I think the patronage will be high.
And as entrepreneurs say, sometimes all you need is a little push, a little nudge, a little burst of inspiration. Penina Karibe, CCTV.
Those enormous birds, tasty on a plate, they wrap up our bulletin tonight. That's Global Business Today, but do remember you can send your feedback on Global Business Africa at cctv.com. Wherever you are online, Facebook, Twitter, you name it, we're there. Well, thank you so much for watching tonight. I'm Ramanyan. I'll see you tomorrow.